Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of discussion is how 10 tax planning strategies for the small business and the entrepreneurs in 2025. So smart tax planning is one of the most effective ways to strengthen your business finances, whether you have just launched your first venture or have been running your company for years. Understanding key tax planning strategies can help you reduce liabilities, improve cash flow, and reinvest more of your earnings into growth. With the passage of the One Big Beautiful Bill Act OBBA, small businesses now have access to the permanently extended tax cuts, new deductions, expanded income thresholds, and the enhanced saving opportunities. Here's how to make most of these updates and build a proactive tax plan for 2025. So the first one is choose the right business structures. Your business structure determine how your income is taxed and what deduction you can claim. Each entity type comes with its own unique benefits. So sole proprietorship simple to establish, but profits are taxed as the personal income, meaning you pay both income and the self-employment tax. Then limited liability company offers liability protection and the flexibility, but LLCs can elect to be taxed as sole proprietor. Partnerships and the S corporations. S corp allows owners to split earnings between the salary and distribution, potentially lowering the self-employment taxes. Then C corporation subject to the corporate tax rates, but businesses may benefit from new OBBA deductions, slightly reduced corporate tax brackets. So, pro tip: if your LLC's annual profit exceeds $100,000, electing S corp status could reduce your self-employment tax burden by several thousand dollars. Just to be sure to pay yourself a reasonable salary and meet IRS requirements before changing your structure. Consult with a tax professional to confirm it aligns with your income goals and the long-term business strategy. Maximizing the business deductions and the credits. The foundation of every strong tax strategy lies in maximizing your deductions and credits. Deductions lower your taxable income, while credits reduce your tax bill dollar for dollar, often yielding even greater savings. Common deductible expenses. Business can generally deduct ordinary and the necessary costs related to the options such as rent and utilities, office rent, electricity, water, gas, internet, and the phone service used for the business. Business insurances premium for the general liability, property, worker compensation, professional liability, or the cyber coverage, employee compensation, wages, salaries, bonuses, and the employer contributions to health insurance or the retirement plans, independence contractor payment, fees paid to the freelancer, consultant, or the service providers, office supplies and the equipments, everyday essentials like pens, printer, ink, and the paper, and the technology used exclusively for the business. Advertising and the marketing cost for the digital ads, website design, and the printed material, sponsorship, and the public relation efforts. Common small businesses tax credits, research and development credit for the business developing new products, softwares, or the processes for hiring employees from the targeted groups facing employment barriers, for the companies providing qualifying health insurance to the employees, for making your business more accessible to the individuals with the disabilities, energy efficiency incentives for the business installing certain renewable energy system or energy saving upgrades available for a limited time, or as OBBBA begins phasing them out in 2025. Take advantage of the qualified business income deduction. The qualified business income deduction, also known as the 20% pass-through deduction, remain one of the most valuable benefit of the small business owners. It allows eligible sole proprietors and the partnerships and the S corp owners to deduct up to the 20% of the qualified business income from the taxable incomes. Key OBBA updates. The 20% reduction is now permanent. A minimum of the $400 deduction applies to qualifying businesses with at least $100,000 of the active income starting in 2026. Also, for the 2026 phase in threshold, the range of the income over which limitation on the deduction begins to apply has increased from $100,000 to $150,000 and from $50,000 to $75,000. More small businesses honor to qualify. So if your consulting firm earns 1,20,000 in profit, you could deduct up to $24,000 through the QBI deductions, assuming you meet eligibility criteria, because the deduction phases out at a higher income levels and excludes some services industries. Working with a qualified advisor is essential to maximize benefit. When you invest equipment, vehicles, or the technology, you can't typically recover costs through the depreciation. The OBBBA expanded options for the faster upfront savings. Section 179 deductions deduct the full cost of the qualifying property up to the annual limit in the year it is placed in the service. Eligible assets include machinery, computers, software, office furniture, and the vehicles. For 2025, the Section 179 expenses limit in the increase to 2.5 million, reduced if the total qualifying purchases cost exceed the $4 million. The bonus depreciation if purchases exceed Section 179 limits, or you want to preserve some deductions for the future years. Bonus depreciation allows an additional immediate deductions for the new and used assets placed in the service between January 19, 2025 and the 1st January 2030. Suppose you purchase two new delivery vans for the 100,000 total in the 2025. You could deduct the full $100,000 under the Section 179. Use $100,000 depreciation to claim the same deduction in 1 year. Either way, you can reduce taxable income by the $100,000, potentially saving $20,000 and the $30,000 in taxes depending on your federal state tax rates. Place these assets in service before 31st December 2025 to secure current year tax deductions. Contribute to the retirement plan. Business owners can reduce taxable income and build personal wealth through the retirement contributions. And Solo 401k, designed for the self-employed individuals or the business owner with the no employee and other than a spouse. It allows you to contribute in two ways, as both employed and the employer. Employer contribution up to 23,500 plus $7,500 catch up if age is 50 or the older. Employer contribution limit is up to 25% of the net self-employment income, combined maximum $70,000. Solo 401k also permit Roth after tax contributions if set up accordingly. A SCP IRA is another strong option for the small businesses, especially those with the employees, and employers can contribute up to 2500% of the income. So SEPIRAs are easy to set up with the minimal administration requirement, but only employers contributions must be made equally for all the eligible employees. Simple IRA. A simple IRA is ideal for the businesses with the up to 100 employees and that want to offer a retirement benefit without a complexity of a 401k. Employees contribution up to $16,000 plus a $3,500 catch up if the age is 50 or the older. Match employee contribution dollar for dollar up to 3% of the compensation, or the make a 2% non-elective contributions for all the eligible employees. Each plan has unique eligibility and contribution and the administrative rules, so it's important to select that one that best aligns with your business structure, cash flow, and the long term goal. So that was all about the topic. Hope this topic will have been beneficial for you. So do subscribe the channel for more videos. Thank you so much.